Hello everybody, I'm Angela Miles at Cboe Global Markets, here today talking about Cboe's corporate bond index futures. Joining me is Matt McFarland. He is head of CFE Strategies and Operations at Cboe, so glad to talk to you today, Matt.
Yeah, I'm glad to be here. Thanks, Angie.
We have a lot to get to. Let's start by talking about this collaboration between Cboe IHS Markit and BlackRock's iShares.
Yeah, we're really excited about the collaboration with Markit and BlackRock. The components of the index in which the futures are based on are derived from the individual bonds that comprise the ETFs that they're based on, which those ETFs being HYG and LQD. HYG being an ETF based on high yield corporate bonds, and LQD being an ETF based on investment grade corporate bonds. And the components of the index that the futures are based on are components that are within the ETF as well. And what that does is it creates a very high correlation between our futures and to the ETFs. And the ETFs are quite liquid in and of themselves, so our liquidity providing community can lean on liquidity in the ETF market to provide strong liquidity in our futures market.
What's your assessment of the corporate bond market?
The corporate bond market is a challenging place to transact. It's a place that has thousands and thousands of securities. It's not centralized. There are wide bid-ask spreads. Our product makes it quite simple to access the U.S. corporate bond market in a very broad manner.
What's the benefit of having the product futures-based?
Yeah, there are a lot of benefits of futures-based product. One is the notional size of the contract. So the corporate bond index futures will have a notional size per contract of about $126,000. Very large notional size allows an institutional investor to create a sizable position with not too many contracts. It's also a very capital efficient product in the sense that the margin requirements are just a little over 1% of the notional value of the contract, about $1,300 per contract. So an institutional investor can get broad exposure to the corporate bond market without deploying a lot of capital to do so. It's also a cash settled product, meaning that at the end of the contract's life, the result will be either a simple credit or debit in the futures account, as opposed to physical settlement, which would be delivery of a huge portfolio of corporate bonds, which could be quite operationally challenging.
What about potential tax advantages?
Yes, futures do receive tax advantages, typically 60-40 tax treatment, where long-term gains are 60% of the gains are taxed at a long-term rate, and 40% of the gains are taxed at a short-term rate.
Who do you see as some of the potential customers?
I think there's a pretty broad spectrum of customers that will find utility in the product. If you think about a pension fund or an endowment that is restricted in terms of the types of securities that they could trade, many of them are restricted from trading ETFs. Our futures contract will allow them to get simple access to the corporate bond market. You think about an insurance company that is a massive investor in the corporate bond market. Our product could be a simple way to hedge that exposure, or if they want to deploy capital into the market because of light issuance, our futures provide them with an opportunity to do that as well. Commodity trading advisors, CTAs, love to have access to a wide range of asset classes. Without corporate bond index futures, they've been unable to access this market, and this will provide them with access as well. And as well, you just have asset managers or mutual funds that have exposure to the corporate bond market, and corporate bond index futures are a great hedging vehicle for them as well.
What would be some examples of potential trading strategies?
I think a trading strategy that will likely be used by a lot of investors is simply hedging corporate credit risk. And if you think about corporate credit risk, there's really two aspects to it: an interest rate component and a credit component. Up until now, the way that interest rate component has been hedged is through treasury bond futures, but that leaves the credit aspect of it unhedged. The credit aspect of it can be hedged through a credit default swap, which is traded in the over-the-counter market, which not everybody can access. But essentially, today, investors have to use two different hedging instruments to hedge all of the risks, whereas our corporate bond index futures allow all of those corporate bond risks to be hedged in just one hedging instrument.
Matt, what are the benefits of exchange trading?
There are several benefits to exchange trading, including centralized clearing. Our corporate bond index futures will be centrally cleared through the Options Clearing Corporation. Centralized clearing minimizes counterparty credit risk. Other aspects of exchange trading that investors should enjoy are things like transparency and price discovery. Those will also be apparent within our corporate bond index futures as well.
Matt, wonderful to talk with you today. Matt McFarland is the head of CFE Strategies and Operations at Cboe Global Markets. So thank you again. I'm Angela Miles, and you can find more information by clicking on the link just below me. I'll see you here next time.